Welcome to Kitchen Table Finance.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic, per usual.
Per usual. Yeah.
We got a great episode today. We got a ton of headlines because it's been a while since we've gone through and done headlines. So we got June, July, and part of August headlines coming up. So I'm going to jump right in because we got a lot to cover today.
Absolutely.
First headline, shocker, drum roll, comes from the Wall Street Journal. And this is actually one of my favorite articles that I've read in a while because it is a firsthand account of a young woman. I say young. I don't know if she said how old she was, but she had an elderly mother, so I assumed. So that can get me into trouble right off the jump. But it was kind of a firsthand taking of her mom was always trying to talk to her about death and dying and finances, and she didn't really want to. And until she started to let those conversations happen, just kind of talking about the importance of letting those people that you're potentially taking care of talk to you about those things and kind of the importance of it. And just struck me as real candid and, somewhat two topics that nobody likes to talk about: death and finances, right?
Finance, right? Yeah, yeah, and family.
And family, yeah, right.
You've got the trifecta, and it's a pretty small Venn diagram there where those overlap and people are comfortable.
Yeah, for sure. Well, it goes to drive home the point that we tell clients a lot of times too, is that these conversations are so critical. If you have wants and wishes, even if you put them in writing, depending on whether or not you tell the people that are making those decisions and how you tell them, can go a long way to how that gets settled and what happens in the aftermath.
Right. Yeah. The best way to think about your estate plan working the way you want it to work is talking about how you want it to work with your kids.
Yeah,
I mean,
right?
that's the bottom line. And I guess the thing I would say about this too, it's not like an on-off switch.
Mm-hmm.
Make it a goal to work towards better communication in the family about money. Don't feel like you need to go from 0 to 60. But
sure.
very good article. I agree.
Yeah, it's one of those, as any good estate planning attorney will tell you, it doesn't matter how good your estate plan is. If your family's going to fight over it, they're going to fight over it, right? And that's going to diminish what you want to see happen.
One of my favorite old estate planning attorneys said a long time ago, just remind your parents when they die, their kids are going to be 12 and 13 again.
Yeah.
And it doesn't matter if they're in their 70s, all the sibling rivalries and everything comes right back. So,
yep. So having those conversations goes a long way to quell a lot of that.
Yeah.
And one other thing of note that I want to say too is, it helps if everybody's in the same room when you're having these conversations.
Yeah.
Because your kids are going to remember different things if you tell them all separately, if you have multiple kids. So
that's a great point. I've seen that many times. Yes. This next one comes from the New York Times, and this was actually forwarded to me by a client, which I always appreciate. And it's basically like some investment basics brought to us by Charlie Ellis, who is a famous Wall Street veterans. It's an interview with him, and it really boils down to the basics that we talk to clients about when building a portfolio, and that the main thing is time. Like the best way to improve your investment performance is to lengthen your time frame.
Yeah.
Pretty darn simple.
Yep. See Warren Buffett for
Right. Some good basic investing frameworks you can't do wrong.
I love it because most of the articles that we come across are like, hey, this one thing will, change your life. This one investment, right?
Yeah. Yep. Or the 60-40 portfolio is dead again, something like that. But yeah. So this is a recipe for doubling your stock market returns again and again from the New York Times. We'll have a link to that.
So going back to the Wall Street Journal, looks like we have an article on required minimum distributions in retirement.
Yeah, just how to think about taking your required minimum distributions. And I threw this one on our list because it echoes a lot of the questions we get from clients usually, when they're in their early 70s and know that RMDs are coming, be ready to take them. And what they're really comparing in the article is whether you should take lump sums versus monthly distributions.
Yeah.
And, we have clients that do it both ways. We've got clients that do a combination of these things. The IRS does not care so long as you reach your required minimum distribution on time.
Yeah.
So, think about how you want your required minimums to work. A lot of people, we take the number and we divide it by 12 and they get a set amount every month. Some
Hmm.
people take a little less than that every month, but then make it up with a lump sum or two during the year. There's no right or wrong. It's just personal preference. And, I end up saying a lot to clients, remember the required minimum is a required minimum. It's not
Right.
necessarily the amount you
Yeah.
have to take. It's just the minimum of what you have to
Right.
take.
Yeah.
The article does dive into like the investment decisions around monthly versus lump sum. And, this is always an interesting thing, but if you're risk averse and you're worried about the timing of when you take your required minimum distribution, then do monthly average,
Yeah.
because then you're never going to be completely wrong or completely right.
Right.
Which works out better just depends on what the market does, and we're never going to know that on the short term.
Hmm.
If
Yeah.
the market goes down during the year, you're better off taking a lump sum early in the year. It's pretty obvious,
Right.
right? If the
Yeah.
market's doing well, you're better off taking a lump sum at the end of the year and enjoying all that
Yeah.
good return. The problem is we don't know in January what the year is going to look like.
Right. Yeah. Indeed. And trying to pretend like we do is a fool's errand. So,
Yes. so so there you go.
so our next article from the Wall Street Journal outlining mortgage rates and refinancing.
Yeah, yeah. So talking about kind of the conundrum a lot of people are facing right now. If you've got a low interest rate from 3 or 4 years ago on a mortgage and you are looking to move, how do you think about that? How do you deal with that?
Yeah. And I think this is a topic that I think is growing in importance as interest rates stay higher, right? And
Yes.
so it's probably one of those that we're going to do a little bit deeper dive on in a future episode, but
Yes.
a good read for kind of thinking through all those things going on and how that's
Yeah.
potentially impacting some of the housing decisions that we're seeing.
Yeah, and just on a high level, things to think about. Don't, no one should buy a house now assuming, if the rate is such that your payment is bigger than you can comfortably afford, you should not buy a house assuming that you're going to be able to refinance.
Yeah,
You may be able to refinance. I kind of expect you will have an opportunity to refinance, but interest
right.
rates are as tricky as anything else in the markets
Yeah,
to project. So don't
for
go
sure.
into a purchase thinking, "Hey, I'll just refinance."
Right. Yeah. Think of it more as an added benefit down the road if it works out, but not something that you should,
Right.
bank on for sure. We've got a sadder article talking about the senior facility going through bankruptcy and how that impacted someone.
As though long-term care planning wasn't complicated enough and fraught with difficult decisions. Now there's been a trend over the last couple of years where some of these facilities that require upfront commitments then fall into financial trouble and can't pay back or make good on the promises they made.
Yeah. And I've heard of some complaints of going into a similar institution like that, getting sold to a private equity
Yes.
company, and then all of a sudden the things that were promised are no longer happening. So there's been some issues there as well. So
Yeah. Yeah.
definitely becoming more and more prevalent and a bigger part of people doing research and figuring out like what do you actually what is your down payment, so to speak, covering, and what does that look like in the next 5 to 10 years?
And how does the organization look in terms of
Right.
solvency and
Yeah.
being there to make good on those payments?
Ooh, we got an article from the New York Times about retirement and how you have, saved your whole life and now you got to turn that money into an income stream. Something we talk about quite frequently here. I thought it was just a good general overlay. Obviously, the first thing they wrote about was the classic 4% approach of just planning on taking 4% out of your portfolio, and talking through how that may or may not work. But also just kind of looking through how you make those decisions, looking at the big picture. Like, are you going to replace your working income? Do you need all of that income?
Right.
Are you going to have a consistent withdrawal rate every year? Is that going to fluctuate? We talk a lot about the SMILE approach to retirement, right? Which is
Yes.
we're using more in the beginning and then it kind of tapers off and then ramps up at the end when healthcare costs go up. Um, and really thinking about your desired retirement lifestyle and legacy goals, also paying attention to inflation and taxes, and something we have done episodes on in the past of your fear of spending and how that plays into it. And then, whether or not you need an annuity to solve some of this. And I think, at the end, it kind of wraps up in the do you need to hire a professional for this? Obviously, we're a fan of that. But one of the things that we say quite often around here is, you spent your career shaping lives and now let's help shape your legacy. And really having someone help you walk through that is super important for a lot of people. Not to say that you can't do it on your own, but maybe it's time to let someone else help you, because
Right.
you've spent your career helping other people. And so I think the big takeaway there is there's a lot of things that go into that people don't think about. And really having some help around those issues, I think, can be very impactful. Otherwise, I wouldn't be doing this every day, right?
Absolutely. That's what we're here for.
The next article talks about helping adult children financially, also from the Wall Street Journal.
Yeah.
About kind of what's going on there, Dave.
Yeah, this one showed up on both our lists for the month, and we talked about we did an episode 6 weeks ago maybe about thinking about your own retirement and how helping adult children can impact that.
Yeah.
This article kind of comes at it from the standpoint of what if it can't be helped? What if
Right.
that is a priority? What do we do to mitigate? It's kind of the second step of what
Yeah.
we talked about
Right.
before, and that's going to impact how much liquid savings you should have.
Mm-hmm.
If you think you're going to need to provide adult children with help, then you need to have more liquid savings ready to do that
Yeah.
rather than have everything locked up in retirement accounts. You need some flexibility around that. One tool they recommended was looking at HSAs.
Yeah.
And
This was kind of veered for me into the obscure. I'm not really sure where and not that there's anything wrong with an HSA, but if your kids don't need health and you're not over, like, yes, you can take money out of it at 65, but you still have to pay the taxes on it, and so it does raise some red flags of how you might use that.
it does. And they also talk about universal life insurance policies as part of that plan. And both you and I would caution, yeah, well, again, it's a tool. It can be used and it may work in this circumstance, but there's a lot you need to be aware of before you try to implement a plan like this using life insurance.
Yeah, it's just much more complex than what you see on the face of, oh, hey, I can just put money towards this policy and then if I need it, I can take it out. And yes, and I can take it out tax free.
Right,
And yes, that's true to a degree, but you really need to know the specifics of how that impacts the actual policy itself, how that impacts,
right,
because where if you take a loan from a policy you don't have to pay taxes on it, but the flip side of that is you're paying more in insurance costs and
right.
you're running the risk of that lapsing, and then you owe a bunch of taxes on it. So yes, it can be a tool, but buyer beware. Make sure you understand every specific impact of it.
Right. Well, and they also talk about purchasing real estate for your kids
Mm,
to live in, um, which again, yeah, on the face of it from a financial standpoint may work well, but boy, beware of what you're getting into in
yeah.
that situation. A, get everything in writing with your kids. If
Right.
that's treat them like tenants, like you would a
Yeah.
complete stranger, and really think about what being a landlord is going to mean for you.
Right.
Again, it might be a good financial answer, but not necessarily the be all and end all. It reminded me of a strategy that was quite popular maybe 20 years ago, of buying a condo or an apartment in the town where your kids were going to go to school
Yeah.
for college, and then
Yep.
using it as an income, and which again sounds great on paper, but boy, you want to be a landlord in the student ghetto of a university town, more power to you.
Yeah.
So
Just think back to
yeah.
when you were in college and some of the things that you did in a rental house before
Oh
you
my.
make that purchase. It's extremely difficult to evict your child, so just know the facts going in, right?
And it's hard to get 19 and 20-year-olds to really care about what they're doing to the carpet and the paint.
Yeah.
So even if it's your own kids, so just beware.
Yeah.
We I think we both had the same sentiment. We like the idea of talking through what adding adult children's goals to your plan might mean for
Yeah.
you, but we're pretty plain vanilla guys. And to
Hmm.
me, build up liquid savings and then save in after tax vehicles that are fairly liquid and tax
Yeah.
efficient is a lot simpler than.
For sure, and gives you a lot more flexibility. So, but some of these other strategies may work for people. I'm not saying that they won't. It's just, it's one of the reasons why we do this, right? Is because it's out there, and then people think,
Mhm.
oh well, this makes perfect sense, and then somebody
This is
sells
this
you
is
a
what I
life
have to
insurance
do.
policy, and it doesn't work
I
that
I have to go buy a house for my kids
way,
apparently.
right?
Yeah.
So, speaking of houses, great transition, Dave. Do you need to own a house in retirement? Many older Americans decide they don't. And so, what we're seeing or starting to see is while normally homeownership climbs with age, the fastest growing group of renters is those in 55 and older, according to the 2023
Yeah.
Census Bureau data, which I thought was interesting. The share of renters 65 and older actually rose 30% in the last decade. Um, and so we're seeing more renting of people in
Mhm.
retirement, which is a complete opposite flip from if you want to retire, you need to own a house and have it all paid off.
Right. Yeah. There's some, and I don't have any statistics around this, but anecdotally, what I expect is probably driving this is looking at the housing market. Hey, we've got, X hundreds of thousands of dollars in equity in this house we bought when our kids were little. And on the flip side, it is very difficult to downsize right now from a
Yeah.
financial standpoint, anyway.
Right.
And we're also seeing the rise of more senior living oriented rental
Yeah.
facilities.
Right.
So, you take those three dynamics together, and this doesn't surprise me.
Yeah, and that's kind of, the examples of the people that they interviewed were, one big benefit was it provides flexibility, right? So,
Right.
hey, I'm retired 60, not really quite sure what I want to do or where I want to live. Well, I can go live in
Yeah.
this retirement
Yeah.
community and rent for a year and see if I like it or not, right?
Well, yeah. Like another way is to think about is maybe people are listening to us,
Yeah.
right? Because you and I preach flexibility,
Yeah.
and I don't think a week has gone by in the last 10 years of my career where I haven't said to someone, renting's not the end of the world.
Yeah,
But,
for sure.
people are programmed to want to build equity, and we've been well trained in that. But
Yep.
flexibility is the downside.
Yeah. Well,
So,
and that's another
um,
one of the points in the article was, with increasing home prices and maintenance, less expensive and also less hassle, right? Like if you
mhm,
rent, you're not, mowing the lawn or fixing
right.
things, or rather you're picking up the phone.
Sounds pretty darn good, doesn't it?
Yeah.
Yeah.
And they also talked about something that you mentioned earlier as well, which is unlocking your home equity.
Right. Right. If you've got your mortgage whittled down pretty far and you've owned that house for a while, you can probably rent for a long time on the home proceeds.
Yeah. Right.
So, yeah.
Next article are talking about the questions to ask a financial advisor.
Yeah. Just another twist on how to vet people in our industry. and it's from the Wall Street Journal. And I think this isn't the first time we've had a similar article make our list on the headlines, but I always like to amplify it when I see it. Um, but they highlight their list of questions with number one being, "Are you a fiduciary?"
Yeah. And I would add to that, will you put it in writing?
Right. Will you put it in writing? How are you compensated? What are your services? What are your qualifications and credentials? I liked this one. I hadn't seen this on the list before. What technology do you use?
Yeah,
And I like that because a lot of times I think you and I share the sentiment. We feel like we're kind of forced sometimes to push technology on people that are maybe reluctant to
yeah,
trust it for their finances. But the world we live in today makes it very difficult with a lot of custodians and a lot of the tools
sure.
out there. They just assume everybody loves doing everything over email and, wants everything delivered electronically. Some people do, some people don't. So ask that question and just make sure you're on the same page up front
Yeah.
before all of a sudden you're being asked to sign things electronically when you really prefer paper, or vice versa. It could go both ways too.
Yeah, and the other thing that I think about here too is, is your advisor using technology, right? Like
Hmm.
use an Excel spreadsheet to do your financial
Yeah,
plan. Like
yeah,
there's a lot of gaps in that, right?
sure. That's another another spin on the same question. I would, I was probably particularly frustrated by something we had to do that day when I wrote that note. Um, I really like the last one too. What does success look like? If I work with
Mm,
you, what does it look like? What's the impact I can expect 2, 3, 4 years down the road?
yeah. I think I like that too. Investment philosophy, making sure that matches. We always talk about how that important that is.
Yep.
And going back, like what are your services? I think is huge because we have this seems like a large portion of advisors who are only doing investment management, and
Hmm.
that may or may not be what you need,
Yeah.
right? If you go back
Yeah.
to that retirement article and talk about all those things that you need to figure out as far as retirement income goes, none of that, I mean, very little of that had to do with the investment side of things. And so you
Exactly.
got to make sure people are checking the boxes of what you actually need. We've actually seen some clients come over from advisors who are just doing investment management, charging similar fees, and they're not getting what they need out of it. So, something to definitely take a look at of what are your services? What am I getting for what I'm paying you? Next article coming from Yahoo Finance and the big fears in retirement planning. Looks like Allianz just did a study, and American confidence in retirement is at an all-time low, according to this. Though
Yes.
doesn't seem very low, but it dropped from
Well,
83% to 70%, according to this
right.
survey.
I was actually surprised at how high those numbers were across the board. Like I'd like to think our clientele is higher than that, but
Right.
I'm surprised if it was a true representative general survey, that seems high.
Main fears are all things that we've talked about
Right.
before: increasing healthcare costs, inflation, stock market fluctuation, and recession. And those last two kind of, you know,
Hmm.
it's I always have to remind myself it's not about what actually happens, it's about how you feel about what happens, because
Yes.
yes, there's been some fluctuations, but unfortunately it's been mostly fluctuating towards the upside. But depending on how closely you're paying attention, you might not feel that way, right? And we haven't necessarily gone into the recession that we've been predicting for the last 5 years, but it always feels like it's around the corner. Exactly.
Right. So what's the solution? Make a plan that accounts for all
Yeah.
these things, right?
Yep, that was my favorite part.
Yep.
Make a
Yep.
plan and
Make a
stick to
plan.
it.
Make a plan. This next one kind of goes with that, talking about surveying folks on how they feel about inflation and their retirement comfort levels. It's from
Hmm.
USA Today, but surprise, surprise, inflation is the number one concern.
Yeah, 57% of people are worried about inflation, and so it
Yeah,
continues. We're not
yeah,
over it yet, right?
yeah. It's the silent killer of financial planning.
Yep, we had a pretty decent inflation number at the last CPI
We
report,
did.
sticking around where we thought where what it has been in the past. So
Wholesale numbers were a little higher yesterday, though, than expected. So, it's going to be a struggle.
This last article from one of our friends at Morningstar, Christine Benz. I say we're friends. I've never actually met her, but maybe someday. Christine,
Big
if you're listening,
fans. Yeah.
big fans, yeah. And this, honestly, I've read a lot of articles on long-term care and long-term care insurance, and this is definitely in my top five. And it just kind of starts with, why insurance, why this, why long-term care insurance in
Yeah.
general might be a good part of your plan. And really, the three big benefits that she talks about is, unlike paying from your portfolio, you get all that coverage from day one, right? And so if something
Hmm.
happens early where you need to go into a facility, you're covered from day one. It's not about projecting how much money you'll have in the future. It's about where you're at right now. You also get a little bit more protection against an extended need, depending on how you structure that policy, which can be, a big help. And then probably the biggest advantage is the peace of mind that it gives you. And I think for a lot of our clients, when we're having these conversations about how they're going to pay for potential long-term care, that is the big tipping point of, I just
Right.
want to have something in place. And even though I could probably self-fund, I'm going to feel so much better about everything going forward by having some insurance in place.
Yes. And, transfer that risk to the insurance company.
Yeah. Yep. And that is really all it is at the end of the day. The second part of the article goes into, who should be thinking about buying and when. And so kind of her general rules of thumb, which I didn't have much argument with, is, if you have 2 to 3 years worth of care out of pocket, self-funding is reasonable. And that is, that's not going to impact your overall plan. It's not going to impact your spouse's plan. That's a pretty reasonable place to think about self-funding.
Yeah. On the other hand, if your cash flow in your retirement plan is tight, or if you're kind of in that marginal area, you probably aren't going to be able to afford long-term care.
Right.
And so we get into this, and this is my big hang up as a planner, is that overlap, if you will, between who cannot comfortably self-fund yet who can afford to pay the premiums gets into a pretty narrow slice. And it's
Yeah.
almost like if you can afford long-term care, you probably can self-fund.
Right.
Like it's been a while since I had someone where it
Hmm.
was like, yeah, you can't afford to self-fund and you can afford the premiums, so we should do this. That's hard. That's hard.
Yeah, it really is kind of a very small gap, like you said. And it's one of those where, and I go back to something another estate planning attorney said, and that is, sometimes we worry so much about it and we spend so much money trying to avoid it. We end up putting ourselves in that position, right? And it's like, I'm so worried about long term care. I got to pay this huge premium where I could be turning around and using that money on keeping myself healthy and out of that
Sure.
facility, which
Sure.
might have gone a much longer way to me doing the things that are most important to me and having a better quality of life. So it's definitely one of those things that you really need to work with someone to figure out where you fall and what those decisions are and look at all the pros and cons, to make sure that that makes sense for you in your financial situation. And then the win is another big thing that, a lot of times what I find is people start bringing up long-term care insurance when they're 70 years old or older
It's
because
too
their
late.
friends are going through it, and by that time it's almost too late, right?
Yeah.
and
Yeah.
and then the flip side of that is you don't want to get it too early, because then you're paying for longer periods of time, and you might have been better off the longer you have before you need it. The self-funding becomes a little bit easier with compound interest and things like that. And so,
Right.
just a couple of statistics to throw at you, Dave. 38% of applications between age 65 and 69 were actually denied coverage, and 47% after age 70.
Right.
So,
So if you wait too long, you are going to have a harder time actually getting the
yeah.
coverage.
But really good article. Definitely recommend people check that one out. I really appreciated all the work that went into that, and just a really good way to start thinking about it, start having that conversation around what and how you're going to cover long term care, because it's not necessarily, you know, Everybody says it's not going to happen to them, but statistically, we know that is not the case. So,
Right.
something that should go into every plan to figure out the uncertainty. So, with that, Dave, that's all I got for you today.
All right. Start a new list.
Yep. Until next time, for our listeners, we will put all these links up in the show notes. So feel free if something caught your eye or interested you, feel free to read that article. And if you have an article you want us to read and review for you, we would love to do that. Shoot us an email at info@srbadvisors.com. And with that, until next time, Dave.
See you then.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.